Holy smokes, folks. I just spent a few days diving into Jeremy's top stock holdings, and I can't wait to break down my findings with you. Let's do it. Welcome back, you brilliant 17,000 subscribers and guests, fans of Jeremy, I'm assuming. I sincerely hope you get value out of this. I'm really excited about it. I'd love to make more of these, so I hope this video does well. I don't just want to dig into Jeremy's top holdings. I'd love to dive into others with you as well. I was looking at Bill Ackman's or Warren Buffett's top holdings or some YouTuber, for example, that you know that maybe I'm not even familiar with, that has talked about their top holdings publicly so that we can explore and evaluate them. You can throw out any ideas you have for me in the comments. Now, for any of these, this isn't meant as an attack or anything like that. I mean, these people have their own standards. They very well may look at stocks and investing differently than I do. And that's okay. My goal is to identify their top holdings, break down the reasons that they've provided as to why they hold them, their investment theses, if you will. And that way I can benefit from some of the research they've already done. And then I'll break down for you with each of their points if, after my own bit of digging, I agree with their argument, or if perhaps I perceive a flaw in the logic they're using. And finally, if it makes sense to do so, I'll give you my own quick take after spending a brief hour or two or more, if it just so happens to be one of the companies that I've studied on my own, poring over the company and collecting my thoughts regarding its long-term prospects. So after you see me go through a couple of these stocks here, I hope you agree that this exercise could be fun and valuable, and we'll let the YouTube algorithm know that with a like and a comment, and by subscribing. I'd love to get to know you better, and sharing whatever you want to do to support. I sincerely appreciate you. Now, before we get into the specifics, Jeremy does identify as a long-term investor. So he's not as worried about potential short-term swings or anything like that, just where it's going to be years into the future. So we'll try to keep that lens in mind as we dig through these holdings. I do also legally have to say that I am a financial advisor, and this is not intended to be financial advice for you. These are just my own personal thoughts and observations on these particular companies. I do not know your personal situation, so I have no way of knowing if any of these holdings would make sense for you or not. All right, so Jeremy's top 10 holdings. Number 10 is Dropbox, ticker DBX. For the record, he says he's not planning on buying any more of this right now. He says it's not the best risk reward on the market at this point in time. But here are the reasons he gives as to why he likes it, why he holds on to it as one of his 10 largest positions. 1, he says it's a successful, great business model. 2, it has a recurring revenue stream. 3, quote, folks need cloud. 4, anecdotally, he says he's been a customer since 2015. He's still a customer. It's the main cloud he uses and he loves it. 5, he says the PE of 22 is low. 6, he says a 3.5 price to sales ratio is way too cheap for a business model like this. 7, he points to a good balance sheet. And 8, a good management team. I thought we'd go through each of those. You know, if those are his main points as to why it makes up such a large portion of his portfolio, let's evaluate them, see how they check out, if we think they hold up as valid reasons to hold this stock long term. Along the way, I'll give you any additional summary thoughts I think you might find helpful from the little time I spent researching it. For those of you unfamiliar, Dropbox is one of the leading cloud storage providers. They started back in 2007 and have since expanded their offering. Now they offer digital signing and sending capabilities similar to DocuSign through their HelloSign arm. Now, it's one thing to look at the numbers they compile for you in their shareholder presentation, but of course, they're always going to show you the information that will paint them in the best light. So I like to dig a little deeper when possible. So one of the important metrics here, to Jeremy's point, is their annual recurring revenue. And when we pull back the data a few years, it's clear that they've been growing this rather consistently, quarter over quarter. What's driving this is their total paying users. And again, you can see a consistent pattern here, a clear, strong upward trend. And then pair that with their ARPU, their average revenue per user, which this one has been a bit more jagged, but again, an obvious upward trend here. I think this information pretty solidly backs up Jeremy's first 2 points. Now, when he says that folks need cloud, he's obviously not wrong. The cloud storage market size continues to climb and is expected to climb by even more in the future. And although it is good to just be in a rapidly growing industry, that observation, and especially Jeremy's anecdote about his personal use, doesn't say anything as to whether or not Dropbox will be the best positioned or even in a good position to capitalize on that growth or anything necessarily about their future specifically. I mean, if we look at it, there are a lot of other players in the space. There are smaller independent players like Box, and then there are the behemoths, which have a way of pushing other smaller tech companies around when there's an opportunity and especially when there's money to be made. Think Google with Drive, Microsoft with OneDrive, Amazon with AWS, and Apple with iCloud. They're all here. I mean, Google Drive only came out with their offering in this space in 2012, and because they were able to pretty seamlessly couple it with the #1 email service provider, Gmail, which of course they own, they quickly stole market share from Dropbox, which again has been around since 2007. And then when it comes to business users specifically, they've tended more toward Microsoft's offering, perceiving it as being the most secure option. Now, Dropbox is obviously doing something right since they've been able to hold their own and have maintained a pretty solid position. But I did notice that when you look at revenue by location, this last quarter was the first time that their revenue declined internationally. And in the US, it relatively flatlined for the first time as well. Of course, one data point does not a trend make, but it does concern me. It does lean into a narrative that they're facing steeper competition. And given that they already have around 700 million total registered users, I'm not sure how much more they can really expand with their freemium model. And you can see this idea further reinforced by their slowing rate of growth. So yes, although we identified a clear uptrend of total users, their rate of growth has been rather rapidly trending towards zero. All right, now Jeremy says Dropbox's PE of 22 is low. But low relative to what? Relative to its past? Yeah, kind of. We don't really have enough data to draw much of a definitive conclusion there. They've spent just as many quarters with negative earnings as they have with positive. And by the way, when those earnings are just barely peaking above zero, it, of course, mathematically exaggerates this ratio, rendering it rather unhelpful. Low relative to other application software SaaS companies? Yes, absolutely. Those right now have an average PE of greater than 40. Again, probably a bit skewed by some with barely any earnings at all. But that industry, especially, it covers a pretty wide range of high-flying valuations. You know, stocks with speculative, exponential growth type potential. I don't think there's any reason to believe that Dropbox should fit into that category at this point. As we've just explored, if anything, their growth has stabilized. We're not waiting on any sort of user growth explosion or untapped value potential to be tapped. So comparing to other SaaS companies where that is the case doesn't make sense to me. It'd be best if we could compare to peers, but that's difficult since none of the smaller peers, Box, DocuSign, have earnings. And the larger ones, well, they do so much else beyond what Dropbox does. So the fact that Microsoft has a PE of 28 doesn't really tell us much about where Dropbox sits in comparison. Now, on the other hand, the fact that Google has a PE that is lower than DBX's might make somewhat of a case for Google, but not Dropbox. Now, a price to sales ratio of 3.5 being too low, again, relative to what? Here, we could compare to Box with its PS ratio greater than 4 and DocuSign with its PS ratio around 8. But the projections for DocuSign and Box's revenue growth over the next few years is about twice the estimates for Dropbox. And their earnings growth expectations are around 50 and 60% respectively compared to Dropbox's expected earnings decline. So that could definitely explain the discrepancy between their price to sales ratios. With that relative context, I don't see any evidence to suggest that DBX's 3.5 PS ratio is necessarily too cheap. Now, to Jeremy's point about the balance sheet, they did have an impeccable balance sheet. That is, until they took out a ton of debt last year to buy back their own shares. As I've talked about in other videos, I'm fine with a company buying back their own stock, but this seems like an odd decision. It looks like they started really doing this at the beginning of 2021 and then continued to buy hundreds of millions of dollars worth of shares even as they were hitting their highest price since the year they went public in 2018. Personally, I'd rather them just have stayed debt-free. On the surface, this move gives their shareholders negative equity, which is not great. But to their credit, they do still have just enough cash equivalents and short-term investments to cover all that long-term debt. So it's also not terrible, it's just weird and seems like some odd financial engineering. So although I'm a bit suspect of financial shenanigans like this, I, for the most part, do tend to agree with Jeremy that on the whole, management seems to have done a great job. They've built up a free cash flow machine here that could offer some flexibility in the future and potentially make them a nice acquisition target. But if I get to choose, and as an investor, we do, I wouldn't want to be in a business that is in direct competition against so many mega cap tech players here. Speaking of mega cap tech, Jeremy's 9th largest holding is Meta, ticker FB. Now, this is one that he indicated that at its current price, he does view as an active buy. He says he's starting to pick up shares again. Here are the reasons he gave. It's one of the best balance sheets you'll find in the world. Quote, for sure top 10, probably top 5. 2, it's trading at a little over $500 million market cap, which is far too cheap. Should be $1 trillion plus easy right now. 3, 4.4 PS ratio is just laughable for this type of business model. 4, a 14 PE ratio is just silly. 5, it just continues to grow and grow and grow. Now, to Jeremy's first point here, I agree. Super sexy balance sheet. I love it. And even though sometimes I think his specificity is arbitrary and entirely random, definitely entertaining, I don't think he's wrong here. Top 5, I believe it. For me, that means that not only are they debt-free today, but that they have a track record that clearly shows a propensity for avoiding debt as much as possible. And then I suppose that I would rate companies by their cash position. So with that, although I've never stacked up all the stocks in that way, I wouldn't be surprised if Meta actually was in my top 5 there. Here's how I broke it down in my past Meta deep dive video. Actually, this is one of Meta's advantages. They pretty much have no debt. Their debt to equity ratio is technically 0.12. They're net cash positive despite these major investments that they're making. They have $50 billion in the bank in cash and short-term investments on their balance sheet, with more than $14 billion in accounts receivable. In total, they have almost $67 billion in current assets compared to $21 billion in current liabilities and $41 billion in total liabilities. Those current assets are enough to buy more than 10% of the company. And they have been doing a lot of buybacks recently. So there's yet another potential positive for shareholders. There you go, you can add that to the list too. Now, as for Jeremy's commentary about its market cap being far too cheap, that it should be a trillion plus easy right now, I'm sure he has more data and information backing that comment, but for you and me as investors, that sentiment alone is entirely arbitrary. You can't just look at a company and say, this company looks like $1 trillion without having something to back that up. So that comment in its own right doesn't really prove anything one way or the other. We need some reason why it should carry a valuation to justify that high a market cap. Again, I know he has it. We just shouldn't, as investors, let that influence us. So let's explore the valuation metrics he threw out there. Now, you could look at a price to sales ratio as a crude means for an attempt at valuing a company. That's often what one might use to determine a relative valuation to peers. For example, if a company was losing money or if they were only barely profitable. But I don't know why you would use it for a company like Facebook that's been profitable for like more than a decade now. In general, and for the record, it's one of the worst ways to value a company. There's just so much that's not included in there. So for this company in particular, I don't care too much about where its PS ratio sits. I want to know how they compare based on earnings. The price to earnings ratio is much more relevant here. So Jeremy's comment about it being 14 and that just being silly is valid. Now, of course, you can't just look at that number in isolation, but pretty much no matter what you compare it to, this PE is objectively low. If you compare it to the rest of the industry, which averages a PE north of 40, to close peers like Google, which carries a PE today of around 20, to its own past, where its own historical low before now was 17.32. And its historical averages has been much higher than that. So yeah, pretty much however you dice that metric, it's showing up as undervalued. Despite the fact that, as Jeremy eloquently points out, it just continues to grow and grow and grow. Historically speaking, at least, he's right. Now I did a deep dive into Facebook not too long ago, and I haven't done that many deep dives because they just take so much of my time, and I think you'll understand why if you take the time to check one out. I go into a lot of detail. So if you're really interested in understanding Meta as an investment, you should check that out after this video. I'll link out to it directly for you. In that video, I explore the concerns investors have that are holding FB shares down. In short, I suspect at this point, a lot of it has to do with the severe negative impact a recession would have on ad spend in general. That being said, as a long-term investor like Jeremy, I'm with him on this one. In fact, spoiler alert, in my detailed worst case, bear case scenario that I outlined in my valuation there, the discounted price target I came up with was very close to where the price of Meta is today. Now, I personally haven't taken a position yet for reasons I outline at the end of that video, that other video that I did, but I do have an idea now of where I will and will likely sell put options around that price as they're available to bring in some profits for my portfolio in the meantime. Now, when I said I haven't done very many deep dive videos, I wasn't lying. I've only done 4, but Jeremy's 8th largest holding just so happens to be another one. So if you're really interested in PayPal, ticker PYPL, you probably want to add that to your watch after this list as well. Jeremy says he loves the PayPal and Facebook risk reward equally right now. I would definitely lean more towards Meta over PayPal, which I'm sure you'll understand after you watch my deep dives and get a better feel for how I invest. But I do think there's some potential here with PayPal. Jeremy calls it an easy money stock. He says he loves it, that it's just going to continue to be a growth stock, and he says that he plans to buy more shares. Here are the points he highlights in his video. He says, 1, under 100 billion market cap, he really likes the risk reward here. 2, quote, price to sales ratio of 3.8 for a fintech like this? Come on, man, 3.8 is just silly. 3, he says, great balance sheet, great income statement, great cash flows, great management. And 4, he talks about PayPal and Venmo being the number 2 and 3 most popular finance-related apps in the world. He says the only one that tops them in the US is Cash App, owned by Square, and that when you own 2 and 3, that's just absolutely amazing. Now, working backwards this time, in that last point, I believe he's referencing popularity based on app downloads, but in actual transaction volume, Venmo dominates the peer-to-peer space. They're, at least for now, well ahead of Block's Cash App. And when it comes to digital wallets, PayPal is way ahead of any other company in the US and Europe. So I think Jeremy's right to point out how absolutely amazing it is for them to own both those applications, but I think he's actually underselling their current command of the market share here. He's spot on with regards to the health of their financial statements. And I personally agree with his comments about management. That being said, there are definitely some out there who would disagree. I think back when PayPal floated the idea of purchasing Pinterest, that left a stain on their reputation that will be hard to remove. And then also the recent shift of their primary focus from client acquisition to client retention, I think that raised some red flags for a lot of investors as well. Now again, on his next point here, I would push against the idea of using price to sales as a primary determinant of PayPal's value. They have enough earnings data. But you know what? In this case, I'll give it to him. That price to sales ratio is just silly. Relative to anything, really. To the industry and especially to their past, 3.8 is objectively very, very low. And more importantly, when you look objectively at their current PE ratio, it's also rather low compared to what they're doing here. And finally, his comment about it being a good value under 100 billion market cap. Again, I'm sure he has some supporting data to back up his belief there. As an investor trying to piece together opportunities, that of course in and of itself doesn't tell me or you anything. But I'll tell you, when I did my deep dive, which I'll link out to in the description, I looked at it several different ways. And the discounted fair value I came up with time and time again was north of $140 per share, which, given their current shares outstanding, would bring their market capitalization up to more than $160 billion. So I'll give them that one as well. Definitely check out that deep dive for a much more in-depth look at the opportunity here with PayPal. Number 7, Avant Brands, ticker AVNT on the Canadian Stock Exchange, or AVTBF if you wanted to pick it up over the counter here in the United States. Now, first of all, being his 7th largest holding, he needs to get the official records updated here. I don't know if he's holding it in trust and hidden in different places. I don't know, but surely he owns more than this entity that owns 250 shares worth $55. It probably owns more than some of the other people on this list. His name should be on this list as one of the top shareholders. Maybe he could even negotiate himself a board seat. How cool would that be? I'm not even kidding here. If he's truly confident in the future of this nanotech company, it could be a sweet opportunity. And it looks like they only have 6 board members at present. Why not? Heck, his followers all together might own enough of this stock to have a meaningful impact on any vote like that, you know? I don't know enough about this one in particular, but I would absolutely love to find a nano or microcap company about which I felt that strongly. I'd love to be able to get involved. I mean, I plan to when I find one and I can. So yeah, if I were Jeremy, given his feelings about the prospects of the company, after all the research he's done and given his current position size, the man should go for it. And honestly, I bet it'd make for some pretty great YouTube content. What do you all think? All right, now that being said, he admitted that this position today is already probably large enough, given the inherent risks that come with investing in such a small market cap company. So he's not buying any more shares at this point. At least that's what he said at the beginning of when he was talking about Avant. But by the end, I think he sold himself on its value again and concluded, I might buy a little more shares of this one, but not a ton. That's what he said. So here are his selling points. 1, he says they're very successful at the product they sell. Look at their latest quarterly results, absolutely amazing. He says the numbers don't lie. Look at the results they've put up over the last several years. 2, he points to the fact that the industry just keeps getting bigger and that there are going to be a lot of bankruptcies, meaning less and less competition. 3, federal legalization is coming. 4, their balance sheet is absolutely amazing. And 5, Norton and the management team at the company have done an amazing job, especially for small market cap companies. Management teams matter in a big, big way. Now, a few years ago, there was certainly a lot of euphoria around this industry. That excitement today has definitely died down, which has led to reduced funding, which, as Jeremy points out, has led to increased bankruptcies and industry consolidation. So Avant getting to zero debt on their balance sheet certainly helps them reduce the risk of bankruptcy, but it doesn't get them entirely out of the woods if they keep losing money. So I think Jeremy has a solid point there regarding the industry, especially as it becomes legal in more and more places. And sure, given their sound balance sheet, this company in particular is probably better positioned than many to capitalize on that industry growth. Regarding his first point though, prompting us to look at the numbers, sure, it looks like they're doing good things from a revenue perspective, but even in their latest quarterly results that he points to, their earnings declined pretty significantly. It's the same story with their cash flows. And if they're losing $12 million in a quarter, and they only have $12 million in cash and equivalents, that's not a good formula for avoiding bankruptcy, let alone to just maintain their strong balance sheet that he loves, part of the reason that he's invested in them. And as you look at this chart, you might be wondering, where did they get all of that cash and how did they pay off all of their debt if they're not actually making any money? And that'd be an excellent question. It looks like they did it by selling more shares in their company, by diluting their current shareholders. You can see where they issued a whole bunch of stock here in 2021. They've done it in the past as well. And you can see where they used it to pay down their debt. And unfortunately, the cheaper this stock gets, the more they have to dilute each time to remain afloat. So I'd be concerned that their clean balance sheet is perhaps a distraction from deeper underlying fundamental problems. That being said, with their continued revenue expansion, they might just become a great acquisition target for a larger player in this space. But I mean, really, the fact that their auditor feels the need to every year officially express his doubt that the company can continue as a going concern, that strikes me as a bit of a red flag. So I think the buyout scenario seems the most likely bullish outcome here versus them being able to remain afloat long enough to actually start becoming independently viable. But again, disclaimer, this is just from a quick 30-minute or so analysis. Jeremy is definitely way more familiar with everything the company is doing. So I'm assuming for his point about the management team that he's been following them for a while and been able to see them follow through on the promises they've made to shareholders in the past. But from what I'm seeing, I would have preferred to see slower growth if it meant self-sufficiency to the point of not needing to constantly dilute shareholders. I'm not a huge fan of the path that they've taken. If I'm missing something here, please let me know in the comments. And you don't have to yell. I'm a sensitive guy. No, but really, we could have a sincere conversation about it, a healthy debate, and I'm always open to changing my mind. And that goes for this next one as well. I have my concerns with how bullish Jeremy is here. I'm looking forward to some healthy civil discourse in the comments. So his sixth largest position is Oatly, ticker OTLY. Here's how strongly Jeremy feels about this position.
When it comes to Oatly, here's the deal. This is the stock I want to buy the most shares of for the remainder of this year. There's no stock in the entire stock market that I want to add more shares more aggressively than Oatly. I want Oatly to be a top 3 position, if not a top 2 position by the end of this year. Right now it's number 6. And by the way, it's climbed to number 6 quickly because this is a stock I pretty much just started adding this year and just been adding, especially as it fell to $5, $4, $3. I just was, I've added so many shares recently, and that's how it built into my 6th biggest position in such a quick amount of time. It's going in top 2 or top 3 long term. And when I say long term, actually, I mean within this year. So Oatly, I'm not slowing down on buying this one anytime soon. I'm just going to continue to load up on shares for that one for a while. I mean, it's at $4 here today. I'll buy the stock all the way up to 10. It would have to go up 150% from here for me to start considering, okay, maybe I'll lay back when it comes to buying Oatly. 150%. So it just speaks volumes about my level of confidence when it comes to Oatly and how many shares I really want to add of this company, okay?
All right, no pressure, right? He feels very strongly about this one. So although it's only number 6 on this list, Jeremy has made it very clear that this is his number 1 buy right now. So what are the reasons he highlights? 1, they're disrupting the entire dairy industry. 2, he says the velocities are ridiculous. He cites getting into new stores and SKU expansion. 3, he says that this is the type of product that makes a new customer a customer for life. He shares an anecdotal story about how he buys oat milk for his whole family every single week now instead of cow milk. And finally, 4, he points to their excellent marketing efforts, saying that they understand it at such a high level and that's so key when it comes to drink companies. To his first point there, yes, they are disrupting the dairy industry, but they're definitely not the only ones doing it, although they do seem to have a pretty solid hold on the oat milk market, especially in Europe. I'm personally not sure how far superior Oatly is versus their competition, of which there are several. Jeremy expressed his opinion that they are superior and thus going to jump more to the front, he says, but I can't vouch for that. I'm also not sure how much of a moat they actually have, considering the fact that there have been several other players come into this space as they've noticed the opportunity. At which point we have to rely on Jeremy's 4th point here, that their marketing keeps them ahead. And yes, that is possible. He cited the excellent example of Monster Beverage, but although possible, I think there are many more examples of companies that were just trying to lean on their superior marketing that ultimately did not pan out. What I mean to say is that I'd rather their superior marketing understanding be a cherry on top of everything else that they have going on. So let's look at everything else. Now he talks about how quickly they're growing, and they are, and that's great, as long as it doesn't distract for too long from their ultimate profitability. Their revenue has been going up like crazy, from $180 million in 2018 to $643 million in 2021. That's a CAGR, a compound annual growth rate of more than 75%. That's incredible. But Oatly's 5-year forward CAGR expectations are, of course, much lower than that, at around 38%. Still good, but as management has been adjusting future guidance in recent earnings calls, their own estimates have been coming down, which has been pretty regularly dropping those future expectations. And I don't think that downward trend of negative pressure is over quite yet. I have significant macroeconomic concerns here. And I know Jeremy is a long-term investor, so am I. If this were a profitable and healthy company, these concerns wouldn't bother me as much. So I hope you'll hear me out. I think Europe, where a bulk of their business takes place, is just now really starting to recognize the impacts of inflation. Germany's inflation numbers just came out way hotter than expected, the same for the entire Eurozone. And considering the ECB's, the European Central Bank's lack of any action, there's no reason to expect that to slow. I mean, they have yet to raise rates and they're still easing, pumping currency into their system. I'd make fun of them, but we just stopped doing that ourselves. Add to all that the fact that with the crisis in Ukraine, the cost of fertilizers skyrocketed. I doubt that has made its way into their figures yet. into the ultimate cost of their oats in the future. And once the ECB does start to try to tackle inflation, if they do, then you're going to have increased recessionary pressures on the people of Europe and globally, really. Either way you look at it, more inflation, a recession, or both, I don't like it for a premium product like Oatly. It's just not a good environment to be loss-making in. This is going to hurt. Think about it. High inflation is especially not good for a business like this on a number of levels. More expensive input costs are going to weigh on their margins. They already have margins well below others in the industry. So increased cost of goods will compress their margins further. Or they could increase the cost of their product, which will naturally, even if consumers weren't experiencing their own inflationary pressures, lead to less sales, lower revenues than the market is currently expecting, which means more downward pressure on the stock's price. But consumers are dealing with their own inflationary issues, which means that even if the price of their oat milk wasn't going up, people will have to start making some sacrifices. Jeremy shares his anecdote and talks about being a customer for life, and that's great. Honestly, when you can invest in brands you use and trust, that is much better than not. But obviously that doesn't say anything about a company's viability, which I know is not necessarily his point here, but it's important to keep in mind when investing. And I think the story he's sharing is probably relatable for a lot of people trying to eat healthier. But that's something people do when they can afford that luxury, when they aren't strapped for cash. But with inflationary pressures the way they are, savings rates are now the lowest they've been since '08. Credit card usage is at record highs. We're just starting to see the impact this is having on consumers. If it persists, you can bet people will give up the perceived health benefits of drinking oat milk for the cow milk that's less than a fourth the cost. So yes, they're getting into new stores, they're expanding their SKUs, they're rapidly growing their revenue. But even if you ignore all the macro concerns I just threw out there, all that still doesn't answer the question about value. How much is this business you like actually worth? And frankly, when you compare to sector peers and even those competing in the same industry, Oatly's price to sales ratio is actually a little elevated. Definitely due to their high revenue projections, sure. But if those come down, as I think there is a high risk they will for the reasons I just stated, this stock's price is going to have pressure from both a multiples perspective and from a revenue, the variable here, perspective. Final thought here on this one. If you're thinking about investing in Oatly, or if you are currently a shareholder, I'd recommend thinking about what's next for them. They want to build out their own facilities so that they can increase their margins. Great. But they're going to run out of money before then. They have around $400 million of cash equivalents in short-term investments. The consensus estimates for free cash flow over the next year have them burning through that. What's next? Do they dilute shareholders? I would certainly hope not with these depressed valuations. Debt financing seems much more likely. They do at least have some hard assets that they could use as collateral, which they'll need in this environment, especially given the fact that they're losing so much money. But debt, unfortunately, is getting more and more expensive, which means yet another expense that will be eating into their margins. And then how long will that sustain them? I don't claim to know the answer to that question. It depends a lot on how all those macro conditions play out. They could be fine, but that's not a bet I want to make. There are just too many unknowable variables there. And honestly, for most of them, I think the probabilities seem, to me at least, to favor the downside. There it is. I said it. Beat me up in the comments. If I'm sure of one thing, it's that I missed something here, something compelling, something that addresses all or at least some of my concerns. So with that, I look forward to reading your thoughts in the comments. Honestly, I'd love to chat with Jeremy here. I'm sure there are things he didn't mention in this video that I failed to notice in my quick analyses. I'm sure he and I could have a solid back and forth on some of these. Now, I know this was just 5 of his top 10. I plan to do all 10, but this video is already pretty long and packed with content, so I thought we should probably take a break. Let me know what you think in the comments. Should I go on and put Jeremy's top 5 stocks in another video? Give me some feedback. In the meantime, I'll leave you with these 2 deep dives I promised you earlier. I sincerely appreciate you spending your time with me here today. I look forward to getting to know you and helping however I can. I wish you all the best. Take care.